So when the Fed lowers the Fed funds rate, there's not any direct correlation, but of course it helps. Obviously it does, because it is an indication that rates in general are starting to ease. What a lot of people should realize is that and you should anticipate this, for example, if you have a HELOC, most HELOCs are tied to the prime rate. The prime rate does directly correlate to the Fed funds rate. So if you have a HELOC, or unfortunately, if you have a lot of credit card debt, if the Fed lowers the Fed funds rate, then what's going to happen is your HELOC rate is going to go down immediately the following month. Your credit card rate should go down immediately the following month. Why? Because credit card rates and HELOC rates are tied to prime, which is directly tied to the Fed funds rate. But when it comes to mortgages, it's kind of a mixed bag. In fact, when the Fed announced yesterday after the meeting that they were going to leave rates unchanged, we had already seen some improvement in the 10-year bond yield. But immediately after the announcement, the bond yield actually creeped back up. It was down to like 4.8, 4.9, or I'm sorry, 4.08, 4.09. And then by mid-afternoon, it was back up to about 412. Now today, as we saw the market opened, I think it sunk in about all this positive hints and indications from the Fed that they're going to probably start reducing the Fed funds rate in September. So that was positive news. I think that helped the bond market open up in a more favorable position. And then you add into that this big jump in unemployment claims. That's a pretty strong signal. Hey, the economy is slowing down. More people are having to apply for unemployment. Add that to the earlier week's JOLT report, where the number of job openings is shrinking. You add those two together, the bond market says, wait a minute, we've got a softening economy. That's what really drove the improvement in bond yields and therefore mortgage rates, not a direct correlation to the Fed funds rate directly.